Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, how you going? We're back again for another podcast in freezing cold Melbourne.
Andrew, I am always good and Melbourne keeps delivering. And yes, you're right, 1 minute it's hot, 1 minute it's cold, but that's Melbourne for you, right?
Yeah, exactly right.
That's it.
Bills, tell us what are we jumping on and talking about today?
Look, the very exciting and enthralling topic of superannuation. We do, and we're going to do a little bit of a deeper dive to give our viewers and our listeners a little bit more information around the different types of super funds to try and help people to understand super a little bit more, with the specific purpose, I guess, that if you're in the position where you need to decide what type of super fund is right for you, at least you've got a little bit more information. And look, I guess the older you get, it's fair to say the more and more relevant superannuation becomes. But we'll do a deeper dive into that. And I'm just waiting for a joke about my age here. So
no joke about your old age. It's purely just, I mean, look, it's one of those things that, yeah, you think about it a lot more when you're older. But in actuality, the sooner that you think about it, the better off that you're going to be, because you're in it for such a long period of time that making sure you've got the right super fund, making sure that it's working for you as opposed to against you is key. And the earlier that you do that, the better off that you're going to be.
Yeah, and I think if there's sort of one message, and I hope there's heaps that everybody gets out of this, but if there's one message that comes out of today, it's that superannuation or super funds, they're not equal.
Yeah.
So when you talk about one super fund to the next, and we'll unpack that, but there's a huge difference. There's a huge amount of options out there, and there's certain superannuation funds that are designed for certain circumstances. We'll unpack that, but not all superannuation is designed equally. That's the key message, I think. And let's get into it and let's unpack it. Andrew, first and foremost, what is superannuation? So not the fund itself or funds.
Yep.
What's super?
So look, supers, it's a trust. That's kind of the easiest way to think about it. It's merely a trust that holds assets on your behalf. It's a tax efficient trust. So superannuation is concessionally taxed generally at 15%. Different story once you meet preservation age and all of that stuff. But it's basically a trust whereby you cannot access the money until you reach a condition of release, which for most people is age 60, permanently retired, or over the age of 65, irrespective of your work status, and you get some tax concessions as a result of that trust as well.
Okay, got it. So it's a trust. And probably just to add to that, in terms of the range of investment options that you can invest in with inside super versus outside super, we should point out that there is actually no difference in terms of what you can invest in. Essentially, everything that you can get access to outside of super, you could do inside of super, depending on which type of superannuation fund that you're in.
Yeah, exactly right.
So we're just talking here about the environment itself and the fact that it's a trust as opposed to sort of what sits in it.
Yep, exactly right. And I think that's a pretty key takeaway, because a lot of people, you think about some strategies that we've spoken to clients about in the past, whereby the recommendation is to put money, towards superannuation, and there's a hesitation because most people think, okay, if I put it into super, it's invested in shares and it's invested in, this, that, and the other, and I don't want to take any risk with it. I just want my money to sit in a term deposit. And there are instances where we've, literally had to explain to clients that, hey, you can put it in a term deposit inside of superannuation, and all of a sudden the interest that's associated with it is tax-free because of, their age and whatnot. So yes, you can invest in basically anything that you want, aside from maybe a house that you live in, or anything that, provides any personal benefit. But in terms of investment assets, you can basically, do anything either inside or outside of superannuation.
Yeah. So we might talk about why superannuation so powerful? I might talk about the rules of preservation, and then obviously we'll overlay that with the tax perspective of super. But like all investments, and I guess it's fair to say that, you know, most of the time when you hear, you know, investment experts, financial advisors talk about investing, always the amount of time that you're investing in a particular investment is critical, because over the longer term, investments is when they start to do their thing in terms of compounding. You get your greatest returns the longer that you hold it.
Yep.
So from a superannuation perspective, and the reason why it's so powerful is because the rules surrounding superannuation, specifically the amount of money that you can take out and when you can take it out, is extremely limited. And it's designed like that on purpose, because the government wants the money to sit in there throughout somebody's working career, so it can compound over time to provide retirement income eventually when that individual decides to stop working and start drawing on their superannuation to generate a income in their retirement.
Yeah, exactly right. And I think that's, I think that compound interest is, what is it? Compound interest is one of the 8th wonders of the world. I think it was Warren Buffett. I'm surprised that you missed the opportunity to pull up a Warren Buffett quote.
I was going to jump in, but I was halfway through a mouthful of coffee, so Andrew beat me to it. But that's fine. I'll do the like and subscribe at the end of the podcast.
We're
right?
swapping roles,
that's
right?
It.
And that's the most powerful tool in superannuation. It takes the guesswork out of, you know, do you pull money out of it? Do you, draw down on it because there's either concerns in investment markets or there's somewhere else that you want to utilize the money for, and forcing you into a position where you have to take advantage of compound interest is its probably most powerful tool. And its second most powerful tool is the tax environment associated with it. So a few things in relation to tax. One, if you're making concessional contributions to superannuation, so that's pre-tax contributions, you're getting a tax deduction for it. So if your marginal rate of tax is, 47% or 37 or 32.5, by putting money into superannuation, you're essentially saving the difference between the contribution tax rate of 15% and your personal income tax rate. So number one, ability to claim a tax deduction on your contributions to it, very powerful. Number two, all of the growth, so capital gains and income, taxed at 15% as opposed to your marginal rate of tax. So you receive an income in an investment through superannuation, you're getting taxed at a much lower rate, so fantastic in that regard. You turn over the age of 65, or you're over the age of 60 and permanently retired, and all of a sudden your income tax rate is at 0.
Andrew, say that again, because we really need to emphasize that and drive that one home, because I love doing this.
I know, I was going to say, I think we've done it maybe on 10 podcasts before. It's say it again, 0.
Hey, at least we're consistent and predictable, right?
Exactly right.
So say that again for everybody who might have missed the punchline there.
0% tax rate once you're over the age of 65, 0% tax rate once you're over the age of 60 and no longer working. So very, very, very powerful from an investment standpoint. I mean, you consider... Let's look at an example of buying an investment property through superannuation. You purchase an investment property, you hold it for, 20 years, you make some very significant capital growth, and then at the age of 65, you decide to sell that property and pay 0 in capital gains tax. It's massive, and you can't compare it to anything else outside of superannuation. And really, superannuation from a tax perspective is an environment that ultimately cannot be beaten.
Yeah, I mean, let's drill down on that for a second. When we talk about retirement income, and primarily that's, the primary driver why we recommend superannuation and strategies surrounding superannuation. But if you have to take, or if when you're thinking about retirement income, if you can eliminate any taxation consequences, it makes achieving the retirement income easier. So as another example, I know you used that one before, but as another example, now when you get paid from your employer, or if you're self-employed, obviously you get a gross amount, your employer withholds the tax, and what hits your bank account is the net amount. So that tax gets paid automatically on your behalf in most instances. in the event that you're retired and not paying any tax, it's like you're getting the full whack. You don't have to account for, the amount that you're going to lose in tax, whether it be, your marginal tax rate or whatever it is. It's all coming straight into your pocket. So for us, just knowing from a opportunity perspective, superannuation, there is nothing else in the Australian landscape other than earning money that's not on the books, but which is against the law, by the way. But there is nothing else that beats it.
Yeah. So you consider, like, let's say let's talk about, we'll talk about 1.5 mil, right? You got 1.5 mil and we're looking at an investment, whatever it is. Let's not even, try and, decide on where it's invested. But let's say it's deriving you an income of 5%, right? You've got an investment of 1.5 mil deriving an income of 1.5%, comparing and contrasting inside versus outside of superannuation. It's all inside superannuation. You get an income of 5%. You're getting $75,000 a year in your pocket. That's your income, and that's your living expenses in retirement.
Yep.
Same asset held outside of superannuation rather than inside of the superannuation fund, and you've got $1.5 million. And Billy's actually just going to pull the numbers up. I was just going to maybe speak to it a little bit more figuratively, but no, that's actually a much better way to go about it. You got $75,000 a year in income, but then you need to minus the tax that's going to get paid on that income as well. So what you've actually got is $58,500 in income because you need to pay tax on that $75,000.
Yeah, so just off the bat, you're talking a $16,500 difference just from that perspective, which is what, $300 per week.
Yeah, huge.
It's massive.
Huge. And so long-term planning is key, is kind of the broad brush statement that I'm going to put out there, because people recognize this fact, but a lot of the time you recognize this fact after it's too late.
Yeah.
You've already accumulated your assets. You're, a few years away from retirement, and all of a sudden it's, how do I drive more money into superannuation? How do I make it more tax efficient? But either contribution rules prevent you from being able to do it, or you've got assets outside of superannuation, and for you to move it inside of superannuation, you're paying capital gains, you're paying stamp duty. There's a whole raft of other consequences as a result of it. The earlier you start planning, the earlier that you're involved in your superannuation wealth planning, the better off that you're ultimately going to be.
Yeah, and I guess from our perspective, the reason why, when we're looking at, as financial advisors, when we're looking at wealth creation strategies from a holistic perspective, the majority of the time we are including superannuation advice in that strategy. And that's simply because we know that down the track, and it may be difficult to see if you're 20 or 30, 40 years away from accessing your superannuation, but we know that down the track, the more money that you've got in superannuation, and assuming that the tax rules are going to be similar down the track, or at least concessionally taxed, who knows what the government's going to do, but we've got to make decisions based on today's rules. That's the reason why superannuation forms a lot of the scope that we tend to talk about when we're having a holistic financial advice and a financial planning conversation, because we know that down the track, you actually can't beat it. And using that example before, that was on a $75,000 income. So if you, even if you say double that, you've got two members of a household in a similar position, you're starting to talk about what, $33,000 extra
per year,
per annum, by actually not doing anything different. We haven't even spoken about the underlying, we've just assumed in your example, Andrew, a rate of return of 5%. That has nothing to do, that tax saving and that amount of income that's hitting someone's pocket, that actually had nothing to do in that example of the underlying investments. Yeah. It's just the structure.
Exactly right.
Andrew, let's pivot into the different types of super funds. We might just give everybody a succinct overview of what's available out there, and do a little bit of a dive into what they are and what they mean.
Yeah, absolutely. Look, generally there's about 4 types of superannuation funds that you can have. There's your industry super funds. We've all probably seen the ads, the little what is it? It's like a square on the side, it's not like quite a diamond
box that's turned on the side.
Yeah, exactly right. So we've all kind of seen the ads of an industry superannuation fund. Generally speaking, lower investment options, most of the time lower cost, although that has been changing as of late, and a bit more of a simple structure of the investments within the superannuation. Above and beyond that, you've got a retail superannuation fund. Most of those were established through the banking sector, so banks offered them, had a little bit more comprehensiveness in the scope of some of their investments, had a little bit more flexibility as to what you can do, and were slightly more expensive as a result of it. You then have wrap or wholesale superannuation funds, very comprehensive around investment options. Generally, you can purchase term deposits, you can purchase shares, you can purchase managed funds, you can kind of do anything that's ASIC approved within the investment landscape. So quite comprehensive around the investments. Historically, were much more expensive, although that's changed quite dramatically as of late. And then in addition to that, you've got a self-managed super fund. And a self-managed super fund is exactly what it sounds like. Superannuation fund that you manage on your own. You do your own tax return. You do your own audit on it every year. You invest it however you like. The money goes into essentially a bank account that you have that's owned by a superannuation fund. And you can put that into purchasing. And most people will utilize it to purchase property. That's the main reason that people buy or utilize a self-managed super fund to purchase either a commercial or residential property. You can do other things like purchase collectible cars or gold or anything as long as it's for an investment purpose. But there's some pretty strict rules around what you can do with that.
Yeah, just in terms of the sort of the three categories that you mentioned at the start versus the SMSF, one of the things that I wanted to point out is with self-managed, yes, as the name suggests, but you become responsible for the compliance of that fund as well.
Yep.
And that's okay, if that's what you want to do, if you understand your obligations and if you're astute enough and organised enough to be able to do it. With the other three types of funds, you actually pay a fee to the trustees of the fund to do that for you.
Yep.
And most of us are used to, at the end of the financial year, just receiving your superannuation statement. Everything's done for you from the compliance aspect of it,
Yep.
making sure that you're basically colouring in within the lines, that you haven't stepped outside because it's their responsibility to do it. Whereas with the self-managed, all of that sits on the individual or individuals of the self-managed super fund. Yes, you do get help. You can engage the services of your accountant or an SMSF administrator, but there's a significant difference from a compliance aspect in terms of what's required from that perspective. So if you are going to go down the pathway of self-managed, we're always big advocates of understanding the complexities associated with it, what underlying investments that you want to get access to that you can't in, say, a wrap fund. And then lastly, and not necessarily in that order, but the cost associated with doing that as well too.
Yeah.
So we tend to find that with self-managed, there is a requirement or a need or a preference towards some form of direct property because you can't do that in the other funds.
Yeah, exactly right. And I think there was a statistic that ASIC released, and it was a while ago, so it could be very outdated information, but nonetheless, I'm sure it hasn't changed all too drastically, but it was something like almost 50% of self-managed super funds, the money sitting in cash.
Yeah.
Which is crazy. Because you can have money sitting in cash or a term deposit in any one of the other funds, and you don't need to incur the cost, complexity, and compliance burden of having a self-managed super fund. So there's the requirement to receive advice is massive in this space because you could be putting yourself down a path that you don't need to go down and can achieve everything that you want without needing to go down that level of complexity.
Yep, no, totally agree. Andrew, how do you decide on what's the best type of super fund? I mean, we obviously see some stuff in the media, very strongly from a marketing perspective in terms of which way to go. You mentioned it before around cash sitting in self-managed. That just tells me that there's a lack of understanding around superannuation, generally speaking. But as an individual, most people, start out their career, their employer has to pay super. It's part of their legal obligation. So if the individual doesn't make a choice, usually the employer recommends something, and that's what it is. So there's no active decision-making process in a lot of the instances. But as an individual looking at this, what do you think about, how do you decide which way to go? Because there's so many different choices out there, and it's filled with complexity. What do people do? What do people look at?
Look, there's a very, very big push at the moment, and a lot of talk and a lot of noise around cost. And I don't want to downplay the fact that, cost is 100% a consideration. So that's one of the primary drivers as to what you look at from deciding on a superannuation fund. But I think that perhaps there's an over-reliance on cost, because cost is only a consideration in the absence of the returns. So if the returns were all identical, then cost would be your main consideration. But the returns, the quality of investment, where it's invested, is not the same across each superannuation fund. So yes, absolutely, cost is consideration. You want to look at a fund that's not going to be charging you exorbitant fees as a management fee. Primarily, if you're looking at an industry retail or wrap superannuation fund. But you also want to be looking at the investments. Where is it invested? How is it invested? Is it invested in good quality assets, or is it invested in assets that are not necessarily going to perform the way that I expect them to perform and grow? Do I want to be invested in an index or a passive investment option that's just going to track and follow the market? Or do I want some more active management and some opportunity to overperform the market? There's the big consideration is balancing out, quality of assets, where it's invested, and the cost associated with the fund as well.
Yeah. While you were talking about that, I was actually thinking about an analogy to try and explain this, because you went down a couple of different ways and all of them were relevant, but some people might be hearing that and going, oh, okay, I don't get it. So I then default back to cost, because that's what the marketing on television has been telling you to do, right? So,
and it's easy to understand.
If cost was the primary driver in all of our decision-making process, and hopefully I hit the nail on the head with this and it resonates with people, and I can't think of it, I'm probably going to not do this justice, but I'll get my message across. Everybody would be driving let's say a Kia, right? They're probably, in terms of cost, that's probably one of the cheapest brand cars that you can get. Hyundai, maybe something.
I got a better example. Sorry.
I had this whole story booked out, right? But everybody would be driving the same type of car, right? Because it's the cheapest. And if you think about transportation, which is the primary purpose of a vehicle, it's to deliver you from point A to point B. There's nothing else in there. There's no comfort, there's no safety, there's no fit for purpose, because you like, going off-road. I've got, a bigger family than you do, so we need more room, or I live a more active lifestyle, so I need bigger boot space. There's none of that. So if you think about it from really the surface level with superannuation, it's the only thing that I think people default to, if there's a lack of understanding, is what's the cost, because that's what we've been taught. None of those other considerations come into it. So just to sort of round out my point before you jump in, Andrew, I think that when you're making a decision, it's not just that. And I think there's a huge piece around a little bit of education. And let's face it, if it's something that's a fair way down the track, it may not be that desirable to educate yourself a little bit, but get educated, spend a bit of time understanding it, talk to some people. And if you can, and you've got the ability to do it, it's definitely worth seeking advice by a professional financial advisor who can help you with this decision. And because if you get it right, over a long period of time, the outcome can be so much better. I can't emphasize that enough.
And look, I was going to go down the exact or similar route, but just kind of maybe put it into an investment perspective. If cost is a consideration, when you're purchasing an investment property, you just look at the cheapest property in that suburb. And that's it. You just purchase that. It's not quite that simple, because the cheapest property in that suburb may not represent good value for money. It may not grow the same as all of the other properties. It may not have the same opportunity for development as what other properties will have. Exactly the same thing with superannuation. Cost is a consideration because you don't want to overpay. You don't want to overpay, and you don't want to be lumped with an asset that, the cost is going to eat away any of the the net returns or the net benefit out of it. But it's an asset at the end of the day, so you want to make sure that it performs the way that an asset does. So that's one consideration, is how's it going to perform, where is it invested, and what's it likely to do moving forward. Second consideration is, hey, even though it may perform, does it meet my preferences from an ethical perspective? Yep. Do I want to, exclude certain assets because I have a, certain proclivity towards, XYZ?
Yep.
That's another consideration. Is it flexible enough that I can change direction in the future? So some funds, if you're invested in it, you have to sell all of the assets if you want to exit a certain investment position. You have to sell the entire portfolio and move into another portfolio. Other funds, you actually have individual ownership of assets, and so you can sell one portion of the assets and purchase, another asset with those funds. So I think it's a much more complicated discussion and education piece, other than just what's the cost that's associated with it.
Yeah, and I might even give a deeper example of that in terms of somebody's sort of life stages changing.
Yep.
Because one of the things that we look at as financial advisors as part of the process is your risk mitigation strategies. So as an example, if you're in a position where you've started out your career, you're with a particular fund, yep, fantastic, it's doing its thing, and then your life circumstances change, you get married, you might have kids, you take on a mortgage, all of a sudden there's a greater insurance need to protect you and your family. Not all superannuation funds offer the same level of insurance cover or insurance flexibility. So where it may not have been an issue or a consideration originally when your circumstances were simpler, all of a sudden it then moves to, hey, this is really important because of where I am from a life stages perspective. And interestingly enough, we've been talking about providing retirement income sort of down the track when you're retired. But if you balance the future need of something like that versus protecting your family today adequately from an insurance perspective, I almost guarantee that everybody will turn around and say the present need is much, much more important than the future need.
Yeah.
So getting that right and having the flexibility around being able to choose and what that looks like, I think that's critically important. So that's just another key highlight of being able to get it right, because it can have some limitations down the track.
Yeah, exactly right. Another kind of call out before we sort of round this out is, what's your overarching strategy? What are you trying to achieve? What are you trying to do with it? Is always the first point in call. So a lot of what we've spoken about is product. We're talking about what's the best product out of a massive pool of investments out there. And I think the most important thing, and one of the big considerations for us, is what's the strategy? What are we trying to get to? What are we trying to achieve? And then let's fit the product underneath it that's actually going to help achieve and asset or get us to that objective. So if, for instance, a goal is to purchase a commercial property that your business operates out of, well, that's only available in one superannuation environment, and utilizing superannuation may be a powerful vehicle to do it, because your tax consequences once you're age 65 are going to be immense. And so, okay, if that's the strategy, well then all of a sudden the product that fits underneath it is it's a self-managed super fund, because that's the only product that allows you to do it. So decide on the strategy, work out what the strategy is going to be, and then the product will kind of slot underneath it to help facilitate meeting that objective.
Andrew, well said and well summarised. I reckon we did that one some justice, and hopefully it gives our listeners and our viewers a little bit more information around superannuation and some of the things to consider when making a decision about what superannuation fund and direction to go in that they should consider.
Yeah, absolutely. And if anyone wants to, reach out, receive any personal advice around, deciding on the right fund or the right strategy for them, or as always, details are in the show notes, so feel free to reach out.
Like and subscribe, and we'll catch you on the next one.
Thanks very much.
Thanks for listening today. If you have any questions on what we've talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.